Good afternoon, good morning, good evening, depending on what part of the world you're in. This is Arlan Suderman, Chief Commodities Economist at StoneX, and it's great to be back with you after this month's USDA crop report. Let's go ahead and get started. I need to put a compliance slide up to give you an opportunity to see and to read that. And we'll talk in a little bit about today's crop report, but there's some other dynamics that are at work in this market that I want to be sure to cover. The managed money has built near record large short positions in these markets, and that leaves them at risk now as we enter into a time of year when those risks of leaning too heavily one direction or the other are growing. And that's one of the reasons that we've seen some short covering of late, and another reason why we've seen some end user buying and adding some coverage of late. You may hear a little bit of noise in the background. I apologize for that. I'm actually doing this presentation from the Nashville airport. We just completed our annual Ag and Dairy Outlook for StoneX and in Nashville, and they're getting ready to travel back to Kansas City where I'm based. So you may occasionally hear a plane outside the window here where I'm operating from. But price is a function of supply and demand as modified by the flow of money. So let's look at those money factors once again. The big discussion is, will the Fed lower or cut its interest rate? That's it's more assumed that it will. Keep in mind that a year ago, the market was assuming a 100 basis point cut in 2023. That didn't happen. Stock market hit record highs anyway, but the funds kept shorting the commodities. So I was asked earlier today, when the Fed finally does cut rates, will that impact the commodity markets? And I said, that's the wrong question to ask. The right question to ask, and I'm going to explain this as I go through this, is what does the managed money expect inflation to do? Because I'm going to show you the slides, which you've seen some of them before. I've got some new ones as well. That when managed money historically over the last 10 years believed that inflation was going to trend higher, they wanted to be long the commodities. And when they felt like inflation was going to trend lower, they wanted to be short the commodities. And that changed the level at which the market managed supply and demand, thus the first slide about being as modified by the flow of money. So we've been flat, no rate changes here now for some time. What's going to happen next? We had a big jobs report that came out this morning, another good jobs report. But there were also some things in there for both the doves and the hawks. More jobs created last month than expected, a lot of them government jobs, big downward revisions to the previous 2 months. The unemployment rate popped 0.2% to 3.9% rate. That's moving in the right direction for the Fed to do a rate cut, but it's still very low. The economy is still resilient and still going strong. The Fed, frankly, doesn't have to cut rates if we continue to see these numbers. In fact, to do so could increase the risk of a resurgence of inflation. So let's take a look at some more of this information. On this slide, you see what the consumer price index has done here since we quit raising rates. And that makes one wonder a little bit, did the Fed quit cutting rates too soon? And so I can't rule out a rate increase at some point this year. That's not a forecast, but I can't rule that out. And I'm not convinced we're going to see a rate cut either. If we get a rate cut, it probably means the economy is turning south. Now, as we look at, and this is something I haven't shown you quite some time, I want to come back to it because after the pandemic, I was showing you this slide quite a bit, and I think it tells a big story here. This is demand for durable goods, consumer demand for durable goods. Durable goods are things that last several years or longer. So it's not like just buying a meal. It's like buying a car or buying an appliance or something like that. And this is adjusted for inflation. So this is actual demand. And you can see that it trended higher at a fairly steady pace. And till we got to the pandemic, and we were all told to stay home, and demand plummeted. And then we got the checks in the mail, the stimulus checks in the mail, and we learned how fun it was to shop on Amazon or Walmart.com. And we started ordering goods, and we switched from a service-oriented economy to a goods-oriented economy. And the demand for goods surged higher. It came back a little bit, but now it's at a new level higher and continuing to trend higher at another plane higher. In other words, we didn't go back all the way to the service-oriented economy that we were, because we got addicted to that feeling of how good it feels to pick up our phone and to order something that we can wrap our hands around and have it delivered to our front door. And that continues to help drive the economy, and it continues to help drive the service sector, which is where inflation continues to be the stickiest. And I know housing is a big part of that. Wages has been a big part of that. But this has been something that's been behind this economy. Now, let's look at government debt. I've talked about this before. This is just the interest on the government debt and how fast it's rising now as interest rates are going higher and those old debt certificates mature, and they're not paid off, so they have to be rolled at today's higher rates. And a record $8.3 trillion worth of these debt certificates will have to be rolled at higher rates this year, in addition to the new debt certificates that we purchased, that the government purchases to do so. Now, where's the money been coming to buy those treasuries, those debt certificates? Well, part of it has been the repo market. That's where the extra cash that's been sloshing around in our economy that's in the banks, that they've been buying certificates in order to park that money. That's been part of it. That money is expected to run out here over the next couple of months at the current pace. So when that runs out, will the Fed have to pull back on its quantitative tightening? Will it eventually, later this year, have to go back to quantitative easing? That's a legitimate question we're facing right now. Maybe it'll have to go to quantitative easing, printing money, so to speak, or creating money, so to speak, electronically in order to buy our own debt certificates, monetizing the debt, if you will, in order to try to limit the upward movement of those longer-term interest rates. Now, China's buying less. Saudi Arabia's buying less of our government debt. A lot of countries are buying less of our government debt, as is the Fed as well. So we got to find demand for that increased supply of treasury certificates, which are increasing at an anticipated rate of about 23% across the yield curve this year. And we do that with higher yields. Tying it back to the commodities now. We see here again, this graph I showed you before, the StoneX commodity index, the commodity index tracker versus the 5-year break-even inflation rate. It's been holding. It dipped down to about 2.08, I believe it was. Now it's back up to around 2.4, trending higher. Will it have a breakout to the upside? The correlation between that and commodity prices over the last 10 years, or the value of this commodity basket, is a strong 0.87, as you see there at the bottom. That's why we're paying attention to this, because when inflation expectations are rising, then the funds tend to, and there is a lag here of 2, maybe up to 3 months, they tend to want to rather be long the commodities rather than short. Doesn't mean every commodity, but it does mean the sector as a whole, and that does tend to lift the water that all boats sit in, so to speak. If you look at the commodity index versus the CPI, the consumer price index, even stronger correlation at 0.89. A little bit weaker here of late, but overall the past 10 years, quite strong. If you look at the grain and oilseed sub-tracker, which only makes up about 14.6% of our commodity index tracker, it still has a strong correlation of 0.87. Now, if we look at 1-year inflation expectations, look how they've risen since that December Federal Reserve meeting. They've doubled essentially since that, sitting at about 3.89 when I looked earlier today. That's up from below 2%, right ahead of that December FOMC meeting, Federal Open Market Committee meeting, which is the policy committee of the Federal Reserve. So inflation expectations are rising. Now, let's look at geopolitical risks. Once again, Russia, Black Sea, continuing to escalate. Ukraine now using its new capabilities it's gained from the West to strike at oil refineries deep inside of Russia, trying to eliminate or reduce the fuel supply that Russia has for the war effort. So that means that Ukraine has far more capabilities than what it's been using now previously. It also has those capabilities to strike at Russian ships, as Russia has capability to strike at ships carrying cargo, bulk commodities from Ukrainian ports. But neither side to this point has wanted to do that in view of the world public opinion that would probably turn on them if they did. But both sides are vulnerable to doing that if they worry about losing the war. So the more we escalate, the more that risk slowly goes up. It may still be well below 50%, but we can't ignore that risk. And if that were to happen at some point to curtail movement of bulk commodities out of Russia, specifically wheat and crude oil, that would be a game changer. So that's why we have to continue to pay attention to that. Near term, we're seeing Ukrainian exports back to almost pre-war levels, as you see from this graphic. So very strong exports flowing out of Ukraine right now. Looking at China, tensions continue to build. And here, I'm going to talk a little bit about the demographics, and I've mentioned that before, and that continues to be an issue of a declining population in China. As we're seeing overall the birth rate falling behind the death rate now. So fewer people to support an aging population. That's still true. And I'm going to show you graphics again on that. But I don't want to forget to tell you about the Two Sessions Conference held every year to set policy for China going forward. Major change in wording of that policy regarding Taiwan, which is one of the hot spots. Taiwan, they had the words peaceful reunification in there in previous years. They took those two words out, and I can't remember the specific wording now. Don't have it in front of me. I apologize for that. That's part of what comes from working on the road and working out of an airport. But they inserted it with words of basically communicating an aggressive pursuit of reunification firmly. In other words, that's a change in intent. So what about possible military invasion? Well, the military budget was increased a little over 7% this year over a year ago levels. Observers say that's not enough to indicate that China's ramping up for a war effort. Remember, they can change that at any time. They're not accountable to anybody. But I would argue that that may be enough. I don't think they want to go in militarily. I think they want to do it with a blockade, which doesn't take as many military resources and expenses, and it keeps intact the infrastructure within Taiwan, where 90 to 95% of the super chips that go in that are so critical to military and business applications are produced in Taiwan. They want to keep that intact. They don't want to do what Russia did to Ukraine. They want it to happen peacefully, if at all possible. So this is a black swan event we have to keep in mind. Black Sea, Red Sea, potential bullish developments for commodities. South China Sea, potentially bearish if we don't challenge the blockade, and that's the big gamble that they would be making, whether we would do so or not. And do they do it before the election, or after the election, or 4 years or 5 years from now? You know, that's the question at hand. But it comes down to then would we put sanctions on? And I think the market would assume sanctions that would limit U.S. commodities going to China. So let's continue to move forward here. Population, again, declining below the birth rate. If we look at the number of workers per retiree in China, we're down to 5 now. If you look 10 years from now, we'll be down to 3. Back in the 1980s, we were at 13 workers per retiree. So that's a structural problem for their economy. And our deleveraging and Europe's deleveraging from China. And now we do more business. We import more from Mexico than we import from China. Granted, some of what we import from Mexico starts out in China, but we're even taking steps to limit some of that now as well. Middle East risks real quickly. Ongoing tensions there. Cargo ships moving through the Red Sea down by over half. Panama Canal still limited until probably at least May, when the rainy season typically starts in that area, assuming that the rainy season will start again and be enough to raise water levels. That's going to be key. Increased shipping and logistics problems are continuing to provide inflationary pressures, going with the theme that I've been talking about. Weather risks. Let's talk about this. Here's a look at precipitation ranks by climate district for the continuous United States versus the last 132 years. Look how dry it's been since January 1st. And you could even go back further than that. It's been a record warm, mild, I should say, winter in the northwestern, Midwest, Northern Plains region, and it's been very dry. They've had some precipitation of late, some areas getting some rain, some areas getting some snow, but they're still very short. Furthermore, if you look at Midwest soils, they're still pretty dry, but they are seeing some improvement. I show you on the left there, that's where we were on January 1, as we look at how dry the Midwest was over here in January 1st. And now we're seeing some improvement, but we still have a ways to go. We need to refill that soil profile before the growing season begins, so that if we do have any problems with a lack of rain this summer, that the crop is able to continue to advance and go forward. So what are we looking at? I'm going to give credit to Eric Snodgrass of Nutrient Solutions here. He put together this graphic that I'm using here, and he went back and looked at some big droughts of the past. And you see those on the left: 1988, 1991, 2002, and of course 2012. And what sea surface temperatures were at that time. Note, in 1991, we were actually looking at warm waters, El Nino waters. Same thing in 2002. Same thing in 2012. That's because it was a transition year. 1988, we were already in La Nina. We were already looking at cold waters. Now, as we look at this year, El Nino is fading. Those warm waters in the equatorial Pacific are fading. But the key is this area is right in here in the Gulf of Alaska, and then this stretch between Hawaii and the Baja of California. If you look at these graphics on the left, you will see that those areas are cold in each one of those years that we had droughts. That is the bigger key to determine when we see a high pressure set up over the Midwest and dry out the Midwest with hot, dry weather. That is the bigger key than is El Nino, La Nina, is that cold weather or cold water in those areas. We're a little cool now. That has very little correlation with where we may be this summer. It could continue to get colder. It could warm up. The models are projecting it's going to warm up, but the models don't have a good track record at this time of year. So that is what we're going to be keying on, is those two areas and what the water temperatures do relative to normal in those two areas. If you assume they're cold, we could have a big drought problem in the Midwest this summer. If you assume the water is warm in those areas, we're probably going to have bumper yields in the Midwest this summer. That's what it boils down to. If you look at the latest European model ensembles and you break out all the different components as they run it multiple times in different ways, this is what the outlook for April currently looks at like. A 42% chance that we're basically a mild, normal temperature spring, maybe a little warm in the east, and very wet. 42% odds. 32% odds that we're a little bit on the cool side in the Midwest and we're wet. And 26% odds that we're hot in April and we're leaning dry, especially in the eastern Midwest. Those are the odds based on the European models. But again, April is a very difficult month. March looks like we're going to add some moisture to that Midwest area, but we need April as well. That's why we're keeping a watch on it. And I'll update you on this on March 28th, where we're at when we do the quarterly stocks and the planning intentions reports. What about the summer? Well, if you break it down for the summer, we have 52% odds here of a warm summer, not a hot summer. If you want a hot summer, that's over here with the 4% odds, and even up in the Great Lakes area, 10% odds there. But basically 52 plus 34% odds, so that's 86% odds that it's going to be normal to a little above normal temperatures. What about rainfall? Well, if you look at this 52% odds, this really isn't a problem. That's really very slightly, either way, wet or dry of normal. Don't get too out of shape about what that map looks like. It's very lightly shaded below normal, and not really a problem even at that warmer temperature at all, especially if we're able to refill the soil profile. Now, let's look at the 34% odds. That's wetter. That would favor really good yields. That's almost greenhouse type conditions in the 34% odds. Even the 10% odds, you're getting some dry pockets here. This is a little bit more of a concern. If you get here at the 4% odds, okay, you got some good rain in here, but you're dry elsewhere. That's a problem. Again, it's going by the odds. We could end up anywhere in there. We're going to keep watching it. I'll keep letting you know. I just want to lay out what the risks are going forward. And the fund managers have to figure out, are they comfortable being this short, near record large short positions? That's what they got to figure out. How does this apply to South America? Well, the area circled there on the map is the center west area where the bulk of the winter corn crop is planted. That had been week 10 days ago, and this is the outlook going into into April. That had been pretty dry, and that's their pollination period for that crop. But it is shifted wetter. Now, that could flip. The confidence at this time of year is very low. That could flip easily. And I'm just saying, when we look at the possibilities there, and I listen to various weather forecasters, I can make an argument toward it turning off hot and dry and Brazil having a short crop. And I can make an argument for them having a really good crop. I would say the odds are heavier toward having below normal yields than they are above normal yields. But I don't want to get your confidence too high and expecting that. It could still go either way. And over the next couple of weeks, we'll get a lot better handle on it, and particularly on the March 28th, and I'm back with you for the next webinar. We should have a lot better handle on what April looks like. So stay tuned and come back then on March 28th. So look at the fundamentals. Today's crop report. Only another 1 million metric ton reduction on soybeans from USDA for Brazil. We saw USDA raise Argentine corn production by 1 million metric tons. I think that's significant. Both of those are significant. To make no bigger cut of Brazil's soybean says we're getting close to having a handle on the size of that crop, and it's not as short as believed, and I believe it's an acreage issue. Acreage is bigger than what we thought. That's my belief. On the Argentine corn, Remember, the early planted corn, which 22% of the crop was planted early in November, early December, that crop was going through pollination during a hot, dry period here a month or so ago. Late January, really, I should say, about 6 weeks ago. And that took some stress. But what this tells me is the crop conditions of the later planted corn that was planted January on, that's doing really well, and that's more than offsetting the losses in the stress from the stress in the early corn and helping make up any potential shortfall from Brazil for the time being. No change to Brazil corn in this report or to Argentine soybeans, no surprise there. So as we look then at the U.S. balance sheet, no change for corn, no change for soybeans. Across the board, no change to the balance sheets for the U.S. domestic. For wheat, USDA cut 15 million bushels from U.S. exports. It's something that I've been expecting. It's something that I've been calling for in my commentary. And we finally saw it because China had been very slow in taking shipment of the wheat that it had bought. I thought that they would roll it into next year, but instead they started canceling. They canceled 4 cargoes this week. We think there may be another 1 to 2 cargoes yet canceled based on what we're hearing. The market has also heard that and has priced it in. If we look at global stocks, basically trending lower across the board, pretty much as expected, with the exception I expected a little higher global wheat. I expect corn and soybean numbers to continue to come down a little bit more. South America is going to be key to that. Not a real game changer in those numbers. If we look at ethanol use of corn for the marketing year to date, we exceed the seasonal pace year to date total needed to hit USDA's target by 90 million bushels. I thought USDA might raise their ethanol demand use for corn in this report by 25 to 50 million bushels. They decided to wait to do so, but I believe that that is coming. If you look at export shipments, we're exceeding the pace year to date needed to hit USDA's target by 27 million bushels. I didn't expect them to make the adjustment in this report. I think if we continue this pace, maybe over the next month or two, they may, but I think they're waiting to see how the next 60 days play out if we continue this upward trend. Sales to China have been dismal. If we look to sales to Mexico, though, that's what's really been strong. We got to take care of that Mexican market. They have been good to us. If we look at yields, U.S. yields at the top, look how strong our yields are. If you look, we're going to be approaching 180, 181 bushels per acre for trend yield this year. China's at like 103, 104 bushels per acre. So they're trying to rapidly adopt GMO corn, but it's tough to get all the farmers with those acre and a half farms to make the change. That's what they're trying to push through to raise their production. Brazil has climate and soil problems. Argentina has tremendous potential to get their yields up if their president is able to get the reforms. I just want you to have that awareness going forward. If we look at the balance sheet here, as I said, no changes. But the key I want to highlight again is what happens with Brazil's winter corn crop. If it's a bust, we could take and add several hundred million bushels to my 24-25 export target. And then our Midwest summer weather becomes critical. On the other hand, if they have a normal or above normal trend crop, we could cut 200-300 million bushels from that export target and balloon these supplies even more. So a lot hinges on that. I may be a little bit light on my fuel ethanol for the coming year. I'm already 75 million bushels above USDA for the current year, as you see there. Feed usage, I'm pretty close to USDA right now. I bumped that higher again for next year. I may be a little bit conservative there, but the bottom line is I'm cutting 2.5 million acres for this next year. It's planting. It may come it may be closer to 3 million acres, but we need to lose corn acres, bottom line. Soybean export sales to China year to date are down 8.2 million metric tons, over 300 million bushels. That is a big problem. Shipments to date in order to hit USDA's lower target this year, though, are pretty close to the pace they need to be to hit that target right now. If we look at crush, we're crushing it, if I can use the terminology, the pun intended, so to speak. We're doing well. We had a setback in January because of adverse weather. So I've had to lower my target, but I still think we're going to end up exceeding USDA's target by maybe 20 million bushels. We'll see where we go from here. Renewable diesel industry is a big reason for that as it continues to expand and we continue to bring more crush capacity online. All right, here's a map again showing where we're seeing expansion of plants, new plants, etc. Notice particularly some of the new plants in the plains. That's an area where we could see expanded soybean acreage this year. Maybe some more in the south versus corn. Cotton's going to be fighting some of those acres, though, as well this year. Soybeans, no change to the balance sheet. But I will say, looking at that export number for next year, again, that's going to hinge on how much do we expand production in Brazil in the coming year. We look at wheat. Apology here. I forgot, trying to work from the airport and get everything done real quick. I forgot to reflect the change in exports. This should be 710, that number right there. So this should be 673 million bushels. The rest of that, my numbers stay the same. I already have my export number down at 690. So therefore I have, but I do have a little bit higher feed number overall. So you can see my numbers there. Now, if we translate that then into by class, we still have too much hard red winter wheat. When China bought all of that soft red winter wheat, we saw this disappear. How much of that will now come back, depending on what China's shipment total is going forward. And if we look at the funds, this is looking at more than just Kansas City or Chicago or Minneapolis. This is looking at MATF as well. Big short positions in the market. And unlike corn and soybeans, where the farmer is really undersold in the U.S. and in Brazil, the Northern Hemisphere farmer is basically sold right now until we get new crop. So if the funds do get scared out of their positions quickly, who's going to be taking the opposite position? That's big if, but that's something to keep in mind. So your take-home points, and then we can take questions. So feel free to put your question there in the question and answer box on the lower right-hand side, and we'll take some of those questions here as I have time before running to catch my plane. Commodity deflation is still the central theme. The world is amply supplied with corn and soybeans currently. But managed money has already priced in those bearish fundamentals with those massive short positions at a time when weather and geopolitical risks are rising in the months ahead in major producing areas of the world. Our grain and oilseed sector still lacks a fundamental story, but the money flow may become more volatile, raising risk for the markets here in the weeks in the next couple of months. Rebounding inflation has the potential to flip the narrative as we get into the second and third quarter of this year to where the funds would want to flip short positions to long. May not happen in every commodity, but it overall, historically, if we repeat history, and that's an if, it has tended to change the price point at which we manage the same supply and fundamentals, demand fundamentals. So with that being said, thank you very much for being here today. And I will stop and take a breath and get a drink of water, and I'll let Victoria tell me about our questions.
Yes, Arlan, we have one question from Eric. How realistic are trend line yields after so many years of below trend line?
Yeah, and that's a fair question, Eric. I hear that quite a bit. But we went through a period before that where it was the opposite, where everyone was saying, is USDA understating trend yields because we were 4 or 5 years in a row above trend yields. And what we find is we tend to go through these plateau periods, some of it related to weather, some of it related to other factors. But I think we showed last year with all the stress that we put the crop through and still produced a record yield, that if we had normal weather whatever that is, that I think 181 bushel trend yield is quite attainable, in my opinion. Now, what's my opinion worth? I've walked many cornfields. Prior to having the job I have, I was an agronomist. So I walked many cornfields. So I have some experience in the field with corn. And I believe we could hit it if we have normal weather this year. So we'll see. But that's a question a lot of people have asked. So that's my opinion for what it's worth. So I appreciate you asking, Eric. All right. Any more questions out there? Well, if not, then I will catch my plane and look forward to seeing you back here on March 28th when we'll go over the quarterly stocks report. Oh, I do see is another question coming in real quick. I think, Victoria, I'll go ahead and grab that. Why the excess ethanol production? Because cheap corn buys demand. Cheap corn buys demand, and that's what's happened. It has helped our margins. We've exported more ethanol. Oh, I see. There's a lot of questions starting to come in now. So, Victoria, I'll hand it back to you to hand me some more questions.
All right. Do you want to handle the last one you just read?
Yeah, that one I think I've answered. So we can move on to the next one.
Okay, the next one we have is, are you surprised that soybean oil remains so sluggish with the ramp in RD?
No, I'm not surprised. I think the industry, and particularly the speculative community, got over-enthusiastic at the speed at which the industry would take up that oil as it was produced. We've seen a rapid expansion of the crush capacity. And keep in mind that the NOPA crush reports that come out and give us the soy oil inventories once a month are only measuring soy oil available at their crush facilities. But these facilities aren't stupid. They were acquiring oil for quite some time before they opened. They were building inventories. And so they're working through that inventory and stuff right now. So it's just a matter of finally getting it into balance. And some of the projects did unfold slower than what the industry or a lot of people expected. I'll say that. It's gone pretty close to what our people, our edible oils team felt. We were fairly conservative, and it's been fairly close to that. So no real surprise. We're still moving forward in a positive direction.
All right, the next one is, what are the impacts of the election in the USA to market year?
Well, I can interpret that question two ways. What are the impact of it being an election year, or what are the impact of the election results? Let me answer the first one. Election year and election years, you tend to get stimulus. Stimulus tends to generate activity in the economy. That tends to favor inflation. And inflation, as I went through, can tend to see money come back into the commodity sector. The results of the election, I'm going to be careful about what I say there, because I've seen so many years, I'm well into my 60s. I've seen so many years when the elections turned out totally different than what they looked like in March. And so it's pure speculation. There's so many different things that happen at this point. Generally, the market's expectation would be that if we had a Trump win, that would be a pro-business type of environment. And so pro-business would be seen probably as supporting higher price levels. And probably, I guess you could draw a conclusion, maybe money coming into the commodities, but you can make arguments the other way regarding increased trade tensions as well. So I think there's just too many variables right now to really make a good assessment this far in advance on what the impact will be, because by the time we get to election day, the world geopolitical situation will likely be much different than what it is today.
Next one is, what is your out on ag land values?
Generally, right now, we're seeing money chasing the hard assets. Even with being deflationary for commodities, we're still seeing a lot of money chasing the hard assets, which means land. And I've seen some projections that even the farmer is going to continue to sink his money into land and bid against each other for land, generally until he gets into his upper 70s, because he's worried about the future of the economy with Congress running up such huge deficits. And while that's not a guarantee that we couldn't have something happen to collapse land values, that does tend to give you some tailwinds on land values.
Any policy surprises on your radar? 50% blend expansion beyond 8 states. REF mandates.
Yeah, talking about the ethanol 15% blend there. We might get some attempts out of the administration trying to generate political support to expand. At this point, I don't see a lot of momentum. I think the big key is going to be what the White House does with the GREET model that is could be key to ethanol being considered a feedstock, a viable feedstock for sustainable aviation fuel. They had promised to give us that answer by March 1st. They've delayed it to at least the middle of this month, probably another 2 weeks, a week and a half to 2 weeks. But that will be critical for the future of demand for ethanol going forward. So that is going to be key. I don't foresee any notable changes on the soy oil side of things right now.
Next one we have is, should lower soybean crush margins lead to lower crush volume estimates?
Yeah, and that's a good question, which I've heard from others as well. But with the new crush facilities opening up, investors want to see a return on their money. And even with the lower margins, they're still making a profit over variable costs, basically, at most of the crush facilities. So I anticipate that we're going to continue to crush at a good pace right now because of that. So even though we're down off of normal levels or 5-year average levels, so to speak, we're still at good enough levels to make it profitable to continue to crush with most of these facilities, perhaps some of the older facilities being a little bit of an exception, but I don't hear too much of that being a problem at this point. That looks like the end of the questions. I thank you very much. I've got a plane to catch. I thank you for being here, and I look forward to seeing you on March 28th. You take care and be careful.